Good morning, students. Welcome back to the session on advanced accounting. We are discussing accounting standards, and today we are going to continue with our discussion on AS7. So I'll just do a quick recap of the part of AS7 we have covered so far. Basically, this standard deals with the construction contracts. And in terms of construction contracts, we understand those contracts which are interdependent, which are something we can say are of a long term, where the minimum period generally which is considered to be is the 12 months. For example, construction of roads, construction of dams, construction of building, they all fall within the purview of the construction contracts. And for these construction contracts, we look at the accounting of the contractors, because contractors are the one who are involved in construction contracts as per this AS7. As regards the accounting which is required, we need to first of all consider the percentage which is completed, because it may happen that during the year the contract has been started, but it may take 3 years to get completed. So every year when we have to recognize revenue, or we have to consider the recognition of revenue, we go by the percentage completion method, wherein we discuss there are 3 ways to complete the percentage completion. One is through technical evaluation, second is through number of labor hours, and third is of course through the total cost, which is the most commonly used method for the purposes of computation of percentage of completion. And this percentage of completion is then applied to the contract revenue. As regards the contract revenue, we understood there are 2 types of contracts which are possible. One wherein the amount is fixed, and the other one wherein the amount will remain fixed in terms of the cost which is incurred, or may change depending on the cost which is incurred. But in respect of this type of contract, which is also called as cost plus, the markup remains fixed. Yeah, so whatever with the cost incurred, same sort of markup will be applied on this. Okay, yeah. So now moving further on this, we can pick up one illustration to discuss this. And I think I also gave you this example too for homework. We can pick this up first of all, and we can begin with this. Okay. So let's go to example number 3. This is page number 1.22. I would also request you to confirm the status of homework, because this particular example was for homework. So I'm sure many of you would have completed this, and other than this, there were some other part which we completed, and I gave you that part also as homework. So quickly, in the meantime, you can please confirm your status of homework. Pooja has some query on AS9. Yes. So all of your queries related to the other topics that we have covered, we'll pick it towards the end of the session. Yes, quickly, yeah. Status of homework. While you will confirm, I'll move on with this example. Yeah, great. Harsh and Pooja though have confirmed. X Limited commenced a construction contract on 1st of April X1. The contract price agreed was reimbursable cost plus 10%. So on 1st of April X1, contract has been commenced, when the contract price will be reimbursable cost plus 10%. Yeah. So that's the arrangement. the company incurred 1 lakh in X1, X2, of which cost of rupees 90,000 is reimbursable. So company incurred 1 lakh in this particular financial year, X1, X2. Okay. Now out of this cost which has been incurred, cost of rupees 90,000 is reimbursable. The further non-reimbursable costs to be incurred to complete the contract are estimated at 5,000. Other than this, 5,000 is also estimated to complete the contract. The other cost to complete the contract could not be estimated reliably. Now in this situation, what do we do? How do we record this? Let's see. Yeah, so if we prepare the P&L extract, let's understand how will this get recorded. In this case, the construction contract says that whatever is the cost incurred, on such a cost, 10% markup will be available. Correct? 10% markup will be available. Yeah. Now, secondly, if you look at this contract, the company incurred a cost of rupees 1 lakh. So that will of course go to the P&L. So it will say to the contract cost, it is 1 lakh. So this cost goes to a P&L. Now the question arises as around the cost which is going to be reimbursed and which can therefore be considered as the revenue for this particular year. So by contract revenue, now out of this 1 lakh cost which has been incurred, only 90,000 is reimbursable. So that means remaining 10,000 will not be available. That is not something which will form part of consideration. So 90,000 becomes the amount on which markup will also be available, plus 10% of 90,000. So this becomes 99,000. This becomes 99,000. Correct? Yeah. Now in this particular year, if you will see, in this particular year, you will see that if we look at the total contract, means not only this particular financial year, but this contract on an overall basis. This contract on an overall basis will eventually result into a loss. Why? Because 1 lakh has been incurred, on which only 99,000 is available as the revenue, plus 5,000 is also expected to be incurred, bare minimum. So if we look at the total cost, it is going to be 1,05,000. Total cost is going to be minimum 1,05,000. Yeah, but on this 5,000 or any other cost which is going to be incurred to complete this contract, will there be any amount which will be available in the form of revenue? No. So if we take the total of these two itself, only these two, so this becomes 1,05,000 and the contract revenue is restricted to 99,000. Correct? Therefore, what do we see? On an overall basis, this contract is a loss contract. Correct? Standard says that whenever at the beginning of the contract itself, or at any point of time we understand that the contract will eventually result into a loss, then such a provision for loss should be created at that very point of time. We should not wait for this contract to get completed. Standard says whenever the loss is anticipated, create a provision for that loss. Okay. So now, in this case, this much cost is already booked, but this 5,000 cost is not booked. Why? Because this will be incurred in future. So we are not booking the future cost, but we understand when this cost will be incurred, there will be a loss. Today there is a loss, but in future again there is going to be a loss. So that's why, what do we need to do? We need to create a provision for this loss. So let's say to provision for loss on this contract, 5,000. So this provision will also be created in this year itself, even though this will be incurred in the next year. So we are not booking actual cost, we are booking only a provision in respect of this, and by which there will be a net loss of rupees 6,000. Okay, clear on this? Any questions in case you have on this, please let me know. In the meantime, I could see a lot of confirmations regarding the homework. Harsh, Pooja Pradeep, Pooja, Srishti, Hina, they have completed the homework. Huh? Very good. Vrinda is asking, sir, why the advance received is not included in the cost of construction contract. See, when you received an advance, that advance is the cash flow. Let's suppose if you receive 100% advance today, will you say that your cost is 100% and incurred today itself? No. Yeah, same is the logic over here. Clear? Yes. Any questions? In case you have on this, please let me know. Otherwise, we'll pick up one more example related to this it's only, and then we'll move further. So if we can go to now page number 1.24. Example 3. Sharon had a query regarding 99,000. How did we get 99,000? So 90,000 was the amount which will be reimbursed out of 1 lakh. Yeah. So 1 lakh is the total amount spent, cost incurred. Okay. Out of this, question says only 90,000 will be reimbursed. Mean 10,000 will not be reimbursed. Only 90,000 will be reimbursed. And whatever amount will be reimbursed, on that amount, 10% markup will be available. So that is how we get 99,000. Clear? Hoping with this next example that we are picking up, you should get more clarity around this concept because it's based on same sort of principles only. You are required to show P&L extract in the books of a contractor in respect of the following data. Contract price fixed is 600. So the contract price is fixed. Okay. So the total contract revenue is what? 600. Cost which is incurred to date. Means till date, what is the cost incurred? 390. Cost incurred is 390. And we understand that in the future, some more cost will have to be incurred to complete the contract. An estimate for that future cost is available. Estimated cost to complete is also available, 260. Yeah, so only this much information is available. So the total cost that we can see to complete the contract is going to be 650. Total cost to complete the contract is going to be 650. Yeah. And let's also compare the total cost with the total contract revenue. Total contract revenue is what? 600. 600. Okay. So now, in this case, can you tell me any of your observations which is important? Now, in this situation, how will you deal this? How will you deal with this? Tell me quickly. How will you deal with this? Amar is asking about the Amar. Let's get on to this example, please, and then I'll get back to your query. Okay. Can you tell me how will you deal this particular type of situation when you know that your total cost incurred plus to be incurred is 650 and the total contract revenue is 600? Yes, your quick comments on this. How will you deal with this? Great. Vrinda is saying there's a total loss of 15. Meman is saying loss of 50. Darshan is saying we will create a provision for further loss. Okay. Tanu is saying cost is above the revenue, which is fine. Pooja is saying net loss of 50 for which provision is required to be created. Yes, this is absolutely correct. Now in this scenario, we understand that it's not only the current year which we need to look at. We need to look at the total contract cost. If we understand that the total contract cost will exceed the total contract revenue, then we need to create a provision for this. Yeah, because the standard says follow the conservative principle, basis which recognize the loss today itself. Let's not wait for the future to be for booking the loss. Loss should be booked today itself by creating a provision for the same. Okay. Now in this case, we understand that there will be a total loss of rupees 50. This is going to be the total loss on this project. Correct? This is going to be the total loss on this project. Okay. Now, some part of this loss will automatically get recognized in the current year. Current year means the cost which is incurred till date. Because if the project is resulting into a loss, then definitely some part of loss will automatically come on the basis of the accounting we will do. The other part of the loss, which doesn't come in the current year, will have to be picked up by us. Let's see, how do we do this? In the question, we don't have the cost which has been incurred as a percentage of the total cost. So this we need to compute. Yes, let's compute this cost. So we get a percentage of 60. Percentage of work completed is what? Actual cost divided by total estimated cost, which is 390 divided by 650, which is 60%. Correct? So in this case, what do we find? That the total estimated cost is what? 60%. Yeah. Okay. Now, let's apply the percentage of completion method in terms of the accounting which is required to be done. In the current year, what is the amount of revenue we will recognize? Contract revenue will be 600 into 60%. So that will be 360. So 360 will be the amount of revenue that we recognize. Okay. And the current year's cost is what? 390. Loss for the current year is what? 30. So if we go by percentage of completion method, what do you see? That in the current year, a loss of rupees 30 has got booked. Okay. Yeah. On the basis of percentage of completion method, which we follow, what do we find? Rupees 30 as loss has got booked in the current year. But on this project, total loss is 50, out of which 30 loss has already got booked. Out of which loss of rupees 30 has already got booked. So what do we need to do? Provision for loss on this contract. That means 50 minus 30 will have to be created by us. Will have to be created by us. So we'll have to create a provision for this loss of rupees 20. This loss would have arisen in the next year, in the future years, but because we follow conservatism, because we follow conservative principle, so that's why we will recognize additional loss in the current year itself in such a manner that the total loss on this contract gets booked in the current year itself. And why are we booking in the current year? Because in the current year we have got to know that the contract will eventually result into a loss. Clear on this? Yeah? You're clear on this? I can see some of your queries. Sonu and Sini were asking about price escalation clause. See, there is no price escalation clause. The information that we had, we are just going with that. Okay, Darshan, I think answered this one only. Okay, Nitya is saying it's a loss of 50. We split the loss as current year and create a provision for next year loss, which is good. We have done this. Pooja Pradeep is asking, sir, in regards of years, we have no data mentioned. So can we assume it to be one of current year and recognize net loss of 50 directly? No. See, the data is available. Very clearly it's available. Look at the question once again. It says cost incurred till date. Cost incurred till date means for the current period. And estimated to complete means which is going to be incurred in future. I have called this as year, you may call this as period, it can be either way. Then I think Saurabh has also computed this. Saurabh has shared the response. Very good. Tanu is saying, sir, how did we get the revenue of 360? It's very clearly available, Tanu. On a contract revenue of 600, we have applied percentage of completion. Very simple. Tanu is saying this is adjusting event. I think you seem to be a bit confused in terms of the concepts. What do we have in terms of adjusting event over here? Nothing. Let's not apply that concept. That was a different concept altogether. We are talking about current year only. We are not talking about future year. We are in current year. We can see something which is happening in the current year and which is then recorded. Adjusting event is in respect of events which arise after the current year. Okay, let's not mix up. Unnecessarily you are creating confusion for yourself. Amar is now clear on this. Vrinda, Pooja, they are clear on this, and Tanu is also clear on this. Very good. So it was very, very simple concept, but very, very important, not only theoretically, but practically also. Many a times you will see this situation at your clients also. Yeah. Okay, so can we move further? Okay, so the next point is around combining and segmenting a construction contract. So now what do you mean by combining or segmenting a construction contract? Let's try to understand this concept with the help of an example. Let's suppose there are certain projects which are going to be awarded. Now what are those projects? A road has to be constructed. Yeah. After a particular stretch, there will be a flyover. And then again, there will be a stretch of road. The authority means the government authority which will award this contract. Yeah, which will award this contract has asked for the contractors to submit bids. So you must be knowing, so for picking up a contract, generally bids are submitted and the best bid will be winning the contract. That is how it runs. Now, first of all, for the construction, there has to be a stretch of road. Let's suppose this is 5 kilometers. Then there will be a flyover which says 1.5 kilometers. And then again there is a stretch of road which let's suppose is 2 kilometers. Now the authority has asked for 3 bids. 3 separate bids for these 3 projects. So let's call these as different projects. Project 1, Project 2, Project 3. The contractor who has submitted the bid has also submitted 3 bids. 3 bids have been submitted. But while submitting the bid, the contractor has worked on his costing in a combined manner in respect of all these 3 projects. Means his budgeting has been done in a combined manner. Budgeting has been done in a combined manner. Means even though he has bid for this particular part, saying this will cost him rupees 5 crore, saying this will cost him rupees 3 crore, saying this will cost him rupees 3 crore. This total calculation has been done by him, and then some part has been allocated to this, some part has been allocated to this, some part has been allocated to this. Okay. The authority has also evaluated the bids. submitted by various contractors. So it's not the only contractor. Various contractors have submitted the bids. Authority has also considered the bids in a combined manner. Even though 3 bids have come, in a combined manner, these have been evaluated. Eventually, when the contract has been awarded, then instead of awarding 1 contract, authority has awarded 3 contracts separately for this, this, and this. So there are 3 contracts which have been awarded by the authority to the contractor. So to a single contract, 3 contracts have been awarded. Now in this entire arrangement, if we look at some of the parts in terms of budgeting, in terms of the cost evaluation, in terms of work completion, everything has been done by executing separate contracts for every project separately. But there is an understanding, there is a very clear understanding on the part of the contractor as well as the authority that all these 3 projects are interlinked. They are interdependent. Means, let's suppose tomorrow, if the contractor completes this project, but then he, let's suppose, backs out. Let's suppose he backs out and fails to deliver the second project. In such a scenario, authority will not pay him for the first project also. Even for this first project, authority will not pay him. Why? Because the understanding is very clear that he needs to complete all these 3 projects. Now, we understand for this project, the contract revenue is 5 crore. For this project, the contract revenue is 3 crore. For this project, the contract revenue is 3 crore. So all in all, the contract revenue is going to be 11 crore. Okay. Now in this particular scenario, the question which needs to be answered is around the 3 contracts which have got separate costs, which have got separate revenues specified in the contract itself. And the question is that do we consider all of these 3 contracts as separate contracts and do the accounting for these 3 contracts as separate contracts, or we combine all these 3 contracts? These are 3 legal contracts. Do we consider them as one contract and do their accounting as if it's a single contract instead of 3 contracts? This is called as combining various contracts and doing their accounting on a combined basis. Let's suppose if we combine these 3, let's suppose if we say that these 3 are not separate contracts, it's a single contract only. In such a case, what do we do? In such a case, we will consider as if it's a single contract for 11 crore, for which percentage completion will be evaluated the way we compute it every time, and the revenue will be recognized. Let's suppose this particular part will be completed. So we'll not recognize 5 crore as revenue. No. We will check what is the percentage completion in respect of this entire contract, and we will accordingly recognize it. Why? Because in a way we have considered as if this entire part is a single contract. Irrespective of the fact that 3 separate legal contracts have been executed. And when do we do this? Standard says when the contracts are interlinked, they are interdependent, their costing, their budgeting has been considered, evaluated in a combined manner. The understanding between the two parties is very clear that even though separate contracts have been executed, which could be for administrative convenience, still both the parties are considering these 3 contracts as a single contract. In such a case, accounting for these 3 contracts will be done in a combined manner. Clear? Clear on this? Number 2. Let's look at it other way around. Now, let us suppose for these 3 contracts, contractor submitted only one bid. For these 3 contracts, contractor submitted only one bid, and that was for 11 crores. Internally, the costing for the contractor was available. He knew that the costing for this particular contract is going to be, say, X amount. For this one, it's going to be Y amount. For this one, it's going to be Z amount. But he submitted only one bid. And the authority also awarded this entire piece as a single contract. For all of these 3, a single contract has been executed by the authority. But even though a single contract has been executed, if the contractor wants, he can complete this part only. He can just complete this part and can walk off. He can just move out of the contract. If he would do this, authority will pay him the amount for completion of work up to this stage. Authority will not say, no, this part is also linked to this part is also linked to this. So till the time you don't complete the full part, I will not pay you. No, authority will not do this. Let's suppose the understanding is very clear that if part of the contract is completed, authority will pay. And he can just move out, and authority can bring in a replacement. Means some other contractor can be brought in and he can then complete the remaining 2 parts. Okay. Now in this case, what do we find? There was one contract of 11 crores. But do we really see this to be as a single contract? No. In substance, this is not a single contract. In substance, what do we find? There are 3 different contracts which are legally executed in a combined manner. They are legally executed in a combined manner. But for the purposes of accounting, because they don't have any linkage to each other, they are not dependent on each other. So that's why accounting for these 3 contracts, or you can say for these 3 activities, should be done separately. Now in this case, the problem which may arise is around the amount. You may have a question that, sir, in this particular situation, how do we determine the contract revenue of this part, and this part, and this part? Because there's only a single contract of 11 crore. So how do we know the amount of this particular activity? We'll not get to know. Standard says that this part will have to be assessed by us. We will have to determine this. And whatever is the market value for this activity, market value for this activity, market value for this activity, those market values will have to be checked by us. And in the ratios of the market values of these three activities, this total contract price will have to be bifurcated. But instead of recording this single contract, we will record these three as separate contracts. So contract 1, contract 2, contract 3. That is how accounting will have to be done. Okay, that is how the accounting will have to be done. Clear on this? Clear on this part? This second situation which we discussed is called as segmenting the contract. Means we had one contract, or we can say we had one legal contract, which for the purposes of accounting will not be considered as a single contract. Instead, it will be considered as if there are three contracts. Means we have segmented the contract. Clear? Clear on this? Any questions, any doubts that you may have on this, please let me know. Then we can also pick up one example around this. Example number 4 on page number 1.25. Yeah, any questions, any doubts? No? So we can move on to this example number 4. XYZ Construction Limited, construction company, undertakes the construction of an industrial complex. It has separate proposals raised for each unit to be constructed in the industrial complex. Since each unit is subject to separate negotiation, he is able to identify the costs and the revenues attributable to each unit separately. Should XYZ treat construction of each unit as a separate construction contract according to AS7 or not? Over to you. Over to you. I'm hoping that you will be able to answer this very, very simple one. Without reading the solution, please tell me what will be the answer. Yes, over to you. Yes, waiting for a response. Quickly, yeah. Yes, quickly. Okay, so I can see your responses now. Harsh is saying yes, it will be a separate contract. Vrinda, Sandeep, then Tanu, they are saying it will be a separate contract. Pooja Pradeep is saying it should be a combined contract. Shraddha is saying it should be a separate contract. Saurabh is saying separate contract. Vandana is saying no, it will not be separate, means it will be combined. Mahima is saying it's a separate contract. Can you also give me the reason? Yeah, all of you who is saying whether everyone, please, whether you are calling this as single or separate, can you give me the reason also? I can see some of the responses coming now. Charu is saying it's a separate contract because there are separate proposals, separate negotiations, separate cost and revenue assessment. Priya is saying yes, all the recognition criteria are met, so that's why separate contract. Mahima is calling this as separate. Vandana is calling this as separate. Okay. Then Pooja is saying this is separate because cost and revenue can be identified separately. Darshan is saying as the construction contract can be easily segmented for each unit separately, we have to treat each unit as a separate construction contract. Srishti is saying each unit will be considered as separate. Amar is saying company wants to recognize the contract cost and revenue separately, so no. Sini is saying yes, it's a separate contract. Khushi, Jay, Gunjan and Nikita, they are again saying it's a separate contract. Nikita is saying because the proposals have been submitted separately. Now it's very clear from the question, if you look at the information, that the contract has got separate prices available. The negotiations have also been done separately. Yeah, the costs and revenues are also identifiable to each unit separately. Okay, so that's why effectively what do we see? That even though a single contract may be executed, effectively they are separate contracts. So that's why separate accounting for each contract should be done as per AS 7. Clear? Clear on this? Now, moving further onto the components of costs and revenue. So far, we have discussed various concepts in relation to accounting of construction contracts. We have understood various considerations which are required to be given while doing the accounting of construction contracts. Now comes the part related to measurement. So far, all of our discussion was towards the recognition. Now let's understand some of the points as around the measurement. Means what will be the amount of contract revenue? What will be the amount of contract costs for the purposes of AS 7? So now, as around the contract revenue, what all amounts will be considered by us? We can say there are certain parts. Fixed or the agreed amount is the amount with which we always start. So whenever we'll start a project, whenever we'll start a contract, we will always have an amount to start with. Yes or no? We will always have an amount to start with. But during the course of the contract, certain variations may arise. Maybe when the project was taken up for construction of building, initially the structure with which the contract was picked up was slightly different as compared to the expectations which are there now. Means the expectation of the customer has got changed. So he has requested for the variations in the contract. Now the moment there will be a variation, the amount will also be increased. Yeah, because of the variations, the cost will go up. And if the cost goes up, definitely the amount of contract revenue will also be increased. Yeah. So one part which can have an impact on the contract revenue happens to be variations in the contract. Number one. Number two is about the price escalation. As we understand that all of these construction contracts are long-term contracts. They are for a fairly long period of time. And at times, they may also get delayed as against the expected completion period. They may get delayed. At times, they may also get significantly delayed because of various administrative problems. And in which case, the costing may go up significantly for the contractor. Why? Because of inflationary reasons, because of the prices which become higher as regards the costs which the contractor is expected to incur. So for these reasons, generally you will find there's an escalation clause, escalation of price. This clause is available, which says that the contractor can ask for price escalation after a certain period of time if the contract is not completed within that period, and that delay in completion is not because of the customer. Is not because of the contractor, but because of the customer. Okay. Yeah. Then there could be certain claims or incentives, etc. Now, what are these claims, incentives, etc.? Sometimes, to get the efficiency in the construction contract, to get this contract executed on a faster note, an incentive may be given. That the tenure for completion of the project is 2 years. But if the contractor will complete this contract in 1.5 years, then he will get 10% value higher than the agreed value. So the agreed value is X, and the contract should get completed in 2 years. But if the contractor completes the contract in 1.5 years, he will get X plus 10%. Okay. So some of these clauses are commonly seen in the construction contracts. So whenever the accounting will be done, this part will always be considered as we have discussed, because this is the base price. These parts are also required to be considered as part of contract revenue, but only when these are clearly agreed between the parties. These are required to be included as part of contract revenue when these are clearly agreed mutually. What does it mean? It means that even though there is a clause for inclusion of any of these parts, there should not be any dispute in relation to any of these parts. If let's suppose there is a variation and this variation is clearly agreed between both the parties, that yes, variation will also be paid, then this will also form part of contract revenue. But if this is under discussion, this is not clearly agreed between the parties, then till the time it is not agreed, till the time we are not certain in terms of any of these amounts, they should not be included as part of contract revenue. Okay, clear on this? Any questions, any doubts that you may have, please let me know in the meantime. Shivam is asking, I think I missed his query. Sir, where the contracts are not interdependent or interrelated, can we assume those contracts as single contract? See, I think you are talking other way around, wherein they are interdependent or interrelated, then they will be considered as single contract. When you are saying they are not interrelated, not interdependent, then they will be considered as separate contracts, not single contract. Okay. Moving on to the next part, that is around contract costs. Here again we have various components. Costs that are direct costs. You can say these are direct costs. What will be the direct cost? Material, etc. Yeah, various items that you purchase for the contract. Then the costs which are attributable to the contract activity in general and can be allocated to the contract. So we can say directly attributable. And third, costs which are specifically chargeable to the customer under the terms of the contracts. Other costs. Now let's try to understand various types of contract costs with the help of some examples. Material is the cost. Then if you look at the labor, if you look at the consultant, if you look at the machinery which is used for the construction work, then the depreciation on that machinery. If the machinery is taken on lease, then the rent on that machinery. All of these are what? All of these are the costs which are directly attributable, or you can say direct costs, yeah, or the costs which are specifically incurred in relation to the project. At every point of time, we need to understand that the cost should be specific to the project. We are not looking at costs which are general in nature, which are not specific to the project. There could also be certain costs which are incurred in relation to the project, but which have nothing to do with the construction activity. For example, marketing cost. For example, selling cost. For example, advertisement cost. Can we include those costs as part of these construction costs? No. Even though they are project cost, even though they are incurred for the purposes of project only, but they have nothing to do with the construction activity. So that's why at every point of time, what we need to do? We need to always be wary of the fact that the costs which are incurred in relation to construction only will be considered as part of these costs. Okay. Yeah. Another aspect which is then required to be considered happens to be in relation to the contract costs. Let's suppose there's a contract which will take 3 years to get completed, and the cost which has been expected to be incurred is 300. Yeah, so 300 is the cost which is expected to be incurred on the project. In the first year, cost of rupees 50 is incurred. That means remaining 250 should come in the next 2 years. Yeah. Now in this case, one of the most important aspects related to this contract accounting happens to be the estimated cost. This 300 is what? This 300 is an estimate. This is not the actual cost. Yes or no? This is the estimated cost. So on this particular day, company estimated cost of rupees 300. Why? Because till the time it is not actually incurred, we cannot say this is the actual cost. And what is estimate? Estimate is an approximation. We understand. And an estimate is something which is subject to changes, which may change. We are not sure about the estimate. And it may happen that after 1 year, when the cost to be incurred should have been 250. Now after 1 year, what should be the cost to be incurred? 250. But let's suppose, due to various reasons, we now find that instead of 250, it will become 275. Possible or not? Yes. And instead of 275, this may also become 225. So we are not saying that the cost will always increase or can only increase. It may also go down. Why? Because initially whatever was the estimate of the management, that may change due to various factors. Yeah. And what is this change called as? This change is called as change in estimate. And whenever there's a change in estimate, how do we record that? That is recorded prospectively. As we understand that whenever there's a change in the estimate, that is always recorded prospectively. It's a change in estimate, which is always recorded prospective. Understood? Clear on this? Yeah. Charu is asking, sir, selling costs are not included in the construction cost, but these are separately charged from the customer itself. These may or may not be charged from the customer, but these are not included in the construction contract costs to be considered for this accounting that we are discussing. Okay. Then I think we can pick up illustration number 1. This is page 1.29. Excuse me. And you should mark illustration number 2 for your homework. Yeah. Okay, so on illustration 1 now, a firm of contractors obtained a contract for construction of bridges across river Revati. Following details are available in the records kept for the year ended 31st March X1. Total contract price 1,000. Work which is certified for the cost incurred. So the cost incurred is 500 and certified cost which is incurred and certified is 500. Cost incurred but not yet certified 105. Estimated further cost to complete 495. Progress payment received means collection from debtors 400. And the collection which is pending means amount to be received from the customers is 140. Now this firm seeks your advice and assistance in the presentation of accounts keeping in view the requirements of AS7 issued by your institute. Yeah. So now we need to look at the accounting of this as per AS7. So now first of all, what do we see? The total contract cost and the total contract price. Total cost is what? Certified cost, uncertified cost, and cost to be incurred. 500 plus 105 plus 495. 1100. Okay, 1100. And the total contract price is 1000. So which means this contract will result in a loss. So there is a loss on this contract. Clearly we can see. Yeah. Total foreseeable loss is 100. And we understand that whenever we find any loss on the contract which is not yet booked, then we need to create a provision for that loss to be incurred in future. Correct? So in the question, just be careful. Whenever you will have some information available, just quickly at the first instance, we need to check whether the contract will result in a loss or not. Yeah, please don't forget that. Okay. Now, what is the cost which has been incurred till date? 500 plus 105. This is the cost which is incurred till date. So now we need to determine the percentage of work completed, which is actual cost divided by estimated cost. Now what is our actual cost? Actual cost is 500 plus 105 divided by 1100. 605 divided by 1100. So can you tell me what do we get? Percentage completion. Quickly. Can you tell me? Pooja Pradeep is saying, sir, it will be 55%. Okay, great. So the percentage completion is now 55. Please remember, in most of the questions, this percentage will have to be computed by you. In most of the questions. Yeah. Now, what is the amount of revenue to be recognized? The amount of revenue to be recognized will be 55%. $1,000 into 55%. It's going to be 550. Correct? Yeah. Now, this much part is clear to us. Now comes the next part, which is around some of the disclosures and which is around the receivable or payable, which at times may be required to be shown in the solution. So let's get on to that part now. Next part is around amount due from or to the customers. Amount either due from or to the customers. Customer means debtor. So how do we compute this? For this, what do we include? Contract cost plus recognized profits. Contract cost plus recognized profit. The contract cost plus recognized profit is the one which has been recorded as receivable in the current year. Yeah, less recognized losses, if any. Okay. Yeah, so this is first part. So this effectively is the amount of receivable that we would have recognized. Okay. Now from this, we need to reduce. So this is the amount of debtor. From this, what do we reduce? Progress payments received. Progress payments received plus progress payments to be received. Okay, so what do we find now? Contract cost which is incurred is 605. There is no profit in the current year, it's nil. But we know that the total contract loss which has been recognized is 100 minus progress payments which have been received and to be received are 400 and 140. Okay, so what do we find? It's 505 minus 540. Okay, so now what do we get? 35. Negative 35. So that means it's the amount due to customers. So as on date, what do we say? The amount is due to the customers. Amount is not due from the customer, amount is due to the customer. Yeah, and if it's an amount due to the customer, so how do we present this? As a liability. So this will therefore be presented as a liability in the financial statements. Correct? Correct? Okay, now next comes the disclosure which is required to be given. So what are the disclosures as per AS7 which are required to be given? First, will be the contract revenue. That is 550. Next will be the contract cost, which is 605. Third is the recognized profits less recognized losses. So this is 100. Yeah. Next is the progress billings. I think it was 140. Sorry, this was 140. So this becomes 540. Okay. Next is the retention. Now, what is retention? Retention means the amount which is billed but not received from the customers. Billed but not received. So this is of course 140. How do we get 140? This is the progress payment to be received, because whatever you would have billed, that you would have collected. That's the assumption. So what is the gross amount which is due to the customers? This we have already computed is 35. Yeah, 35 we have just computed that the amount is due to the customer. It's not due from the customer. 35. So in the financial statements, in the notes to accounts, all of these amounts are required to be disclosed. Clear? Clear on this? Any questions, any doubts that you may have on this, please let me know. I can see a lot of your responses in the meantime. Pooja answered this, Saurabh answered this. Pooja is saying, sir, why is the total loss of 100 lakhs recognized in current year itself? We should be considering 55% and 45 lakh is to be provided for. See, when you provide for 45 lakhs, that is nothing but a loss in the current year only. Yeah, so you'll add those two. The moment you will add those two, it will become 100 only. Yeah. So you are answering your question itself. Correct, Pooja? Yes, any more questions? Quickly, any more questions, any more doubts that you may have? No, so you are clear on this? Any questions, any doubts? Quickly, yeah. Please confirm. Are you done? Clear on this? Meman is asking, sir, why 140 is added and this is also the retention amount? See, it's something which is given in the question. The total billings that we have are 400 and 140. 400 is already billed. 400 is already billed. So that's why we are saying this much amount is billed and collected. So whatever is not billed is the amount which is held by the customer. Retention means something which the customer has held, okay, and which will therefore be collected by us. So this becomes 140. Pooja is clear on this. Charu is saying, sir, I have some doubts regarding AS 29. Let's park all of those doubts towards the end of the session. Okay, Sandeep is clear on this. Shivam is clear on this. Great. Amar is asking for a break. Yes, we'll now take a break. Don't worry. Charu is saying, so the net loss in AS7 illustration 1 is the balancing figure. No, it's not the balancing figure. If you compute it, you will get 100, and we have computed this. Yeah, please go to the beginning of the solution. We computed this. Okay, clear? So I think we can then end our discussion for this standard now. We are done with this standard. So let's take a break now. After the break, we will start with a new standard. Yeah. After the break, we will start with new standard. In the meantime, if you have any questions, any doubts around this, please let me know. Okay, so we are done on this standard. We will begin with the next standard after the break. Yeah, so we'll pick up AS22 now. After the break, we will pick up AS22, which is very interesting and very important topic. Okay, clear? Okay, perfect. So then let's take a break. After the break, we'll start our discussion with the new topic, that is AS22. Ram. Hi, welcome back. So we'll now continue with our discussion. We'll begin with AS22, but before this, I can see some of your queries. So I'll just quickly answer those queries. Gunjan is asking, sir, how do we get to know that we have to compute this? See, this will depend on the requirement of the question and the weightage of the question. Madhuri is asking, sir, we have already included that 140 in 540. Why we are writing this again? Because this 140 is the retention amount and you are required to disclose this amount separately. Okay, so it's about giving the breakup in a way, and which is the requirement of the standard in terms of the disclosure. So you're not repeating the number in terms of doing any calculation. You are just disclosing it once again that out of this 540, 140 is the retention amount. That's it. Vrinda is asking, sir, we are clear on this, but we need to follow any sequence of the disclosures? So the sequence that we have discussed, you can just follow the same sequence, or even if you change the sequence, it doesn't matter so much. Important thing is to cover all of these items. Vrinda is asking, we will consider outstanding expenses, example, outstanding labor expenses as part of the contract cost. Yes, definitely. So whether it's paid or not paid, both the costs will form part of your contract cost. Yeah. Okay, now moving on to AS22, which is about deferred taxes. Largely, this standard talks about accounting for taxes on income. And before I get on to this standard, if you can just quickly confirm, all of you please, I need this confirmation from everyone, whether you have covered income tax or not. You have some knowledge of income tax or not? Yes, quickly. I'm waiting for a response. Quickly, have you covered income tax? Yeah, have you read income tax maybe in graduation? It's not necessary that as part of this course only, whether you understand the concepts of income tax or not. Quickly. Some of the basic concepts of income tax, whether you have read that or is that subject completely new to you, which you have not read at all. Quickly, please confirm. Harsh is saying not yet covered. Charu is saying yes, that is covered. What about others? Quickly, quickly. Okay. Vrinda is saying no. Pooja Pradeep is saying yes. Sandeep is saying no. I think Niveda is saying yes. Okay. What about others? Okay. Fiza is saying yes. Hina is saying yes. So I can see mixed responses from you. So let us begin with AS22. Now, in respect of AS22, the focus area for us is going to be deferred taxes. Deferred tax. Yeah, that's the concept which is going to be the focus area, which is going to be the focus, which is actually the focus area of this standard also. And broadly, we can say that in this standard, we will be dealing with the accounting of certain differences, which arise between accounting and income tax. Certain differences which arise between accounting and income tax. Yeah. I can see some more responses now, but let's get on to this concept now. Now, as part of the standard, these two terms are very important to be understood. Because if you don't know these two terms, if you don't know any of these two concepts, then this standard will become very difficult to be understood. Just give me 1 minute. Just give me 1 minute. There are certain differences between the way a transaction is treated under accounting and income tax. Those differences are also required to be reported in the financial statements. That is the premise of this accounting standard. Okay, so that's why it's very important for us to understand the concepts, principles of income tax, which some of you are saying we don't know, which is fine. But please remember one point, that till the time you will not have much clarity on income tax, you may find this accounting standard to be a bit difficult. Yeah, so that's why your knowledge of income tax, or at least the basic or knowledge of income tax, is very important for you to understand this accounting standard. For the purposes of our discussion, we will also discuss some of the principles of income tax so that you can find that relatively easier. But for you to get into the greater detail, in-depth understanding, your knowledge of income tax is very important. Yeah, clear? Okay, now for us to understand the differences between these two, I'll just pick up some of the examples, some of the basic examples, and accordingly we can get on to understand the requirements of this standard. This profit or loss which we compute in the statement of P&L. Correct? We all know about this, that the profit or loss is computed in the statement of P&L. Yeah? Accounting profit, or you can say the profit as per the books of accounts. How do we get it? Through the statement of P&L. Through the statement of P&L. Yeah. Now let's suppose while computing a profit, a depreciation charge was considered. Say we got a profit of rupees 1000, wherein a depreciation charge was considered, equivalent to 100 rupees. Means after reducing depreciation in the books, profit came out to rupees 1000. Yeah. Now, how do we compute depreciation in the books? On the basis of estimated useful life. Correct? This depreciation is computed based on estimated useful lives. This depreciation is computed based on estimated useful lives. Correct? Now this depreciation, which we have computed in the books of accounts on the basis of estimated useful lives, is not accepted by the income tax department. Yeah? Some of you who don't know income tax may be wondering, so how is this possible? But yes, it's true. Income tax is an act. It's a law. And it has got its own provisions, its own methods of computing the depreciation. Means the way depreciation is computed as per books of accounts is different from the way income tax requires. Yeah, there's a difference between these two. Yeah, okay. Now let us suppose the way income tax will compute the depreciation, the rates of depreciation which income tax will consider, let's suppose, are different. The methodology which income tax will consider is different from the one which we have considered. And let's suppose if we go by income tax, then the depreciation charge will come out to be 150. Means in the books we have charged depreciation of 100, but as per income tax, the depreciation should have been 150, higher than what has been considered in the books of accounts. Now, as a result of this, can any of you tell me what is going to happen? Yeah, can you please let me know what is going to be the consequence of this? If, let's suppose, the way depreciation is computed as per books of accounts is different from the way income tax requires, what is going to be the impact? Yes, quickly, over to you. I'm waiting for a response. What is going to be the impact? While you answer this, I'll move ahead with the solution. But please send me your responses. Huh? If, let's suppose, I have computed a profit of 1000 after considering a charge of 100 as depreciation, which income tax does not allow. Income tax says, no, I don't consider this depreciation. You should compute the depreciation the way I require. So what will happen? When I will compute the profit as per income tax, I will have to add back this depreciation. I will have to add back this depreciation. And I will have to reduce the depreciation the way it is computed as per income tax act. I will have to compute this or deduct the depreciation the way it is required by income tax. Yeah. As a result of which the profit will go down to 950. Can you see this? Now the profit has gone down to 950. And I can see some of your responses now. Harsh is saying, if we do this, profit will vary. Yes, this has not varied. So are we saying accounting profit will be higher than profit as per income tax? Of course, we can see that happening over here. Rekha is saying profit will get impacted, which is true. Vrinda is saying accounting according to income tax. According to income tax. Oh, so I can see a lot of queries. Our profit is less than as per books, which is true. And same is the response from so many of you, Shashank, Jagdevi, Fiza, Vivek. Pooja is saying, sorry sir, I have not covered, so no idea. No problem. Anyways, you'll understand this over here. Riya, Meman, Vinod, Shraddha, very good. Now, what will happen? Income tax is required to be paid by the company or the entity or any person. Now, income tax will be paid on which amount? 1,000 or 950? Income tax, as we understand, is payable on the profits of a person. But which profits? The profits which we show in the books of accounts, or the profits that we show as per the provisions of income tax. The profits that we show as per the provisions of income tax means this profit. Yeah. So now some of you may be thinking that this means that the profit which is shown in the books of accounts is of no use. No, that is of use. That is of use to the business. But that is of not much use to income tax. Or you can say that will become the basis for you to compute your income tax or for you to compute your taxable profit, but that will not be the taxable profit always. We can see that. We can see that over here. And why there is a difference between these two? Because there are certain items like depreciation. Depreciation was only an example. Like depreciation, there are certain items whose treatment is different in the books and income tax. Means those items don't have similar treatment in the books of accounts and income tax. And because of which they create the differences between the profits as per the books and profits as per income tax. So this profit of 1,000 is called as accounting profit. This profit of 1,000 is called as accounting profit. And this profit of 950 is called as taxable profit. This profit or income is also called as accounting income. This is also called as accounting income. And this 950 is also called as taxable income. So we can say profit or income. It can be either way. Yeah. And in case there's a loss, then we will call it as accounting loss. And in case there's a loss over here, we will call it as taxable loss. Yeah, understood? Two terms which are the most important terms: accounting income and taxable income. And hopefully you have also understood that accounting income and taxable income may not be same always. There could be certain differences between these two. And what is the reason for difference between these two? Very simple. Items like this, whose treatment is different under books and income tax. Okay, clear? Now, this was briefly about some of the terms which are going to be used: accounting profit, taxable profit, accounting income, taxable income. But let's now come to the point. Why are we discussing these terms? what is it that we need to understand in terms of deferred tax? How is this relevant? What impact it will have on the financial statements? Because at the end of the day, we are not reading income tax. We are covering accounting. Yeah. So there has to be something which we need to know, which will have an impact on the financial statements. So let's come to the point now. In the meantime, let me just see in case you have any queries. No? So it seems you were all clear on these basic terms which we have used. Very good. Now, let us continue with this example. Yeah. So we were discussing about an item of PPE, an asset, which was PPE. Yeah. Let's suppose which has a value of 1,000. So there's an item of PPE which has a value of 1,000. And let me just take few years. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Let's suppose as per accounts, as per books of accounts, the life of this PPE has been considered as 10 years. Its life has been considered as 10 years. So what is going to be the depreciation charge every year? So every year, what is going to be the depreciation charge? Amar, please wait, have patience. Let us discuss whatever we are doing. Automatically will come to all of those points. Every year there will be a depreciation charge of 100. Correct? Let's suppose as per income tax, the depreciation charge will be 20%. Only for an example I am discussing. I am not checking the exact, I am not taking the exact rates of depreciation and exact methodology. This is only illustrative. Yeah, so some of you who know the income tax provisions don't think, sir, but the way income tax computes, it's not same. So what will happen? There will be a depreciation charge of 200, then 200, then 200, then 200, then 200, then it will become nil. Correct? So this is how it will work. Yeah. Yeah. Okay. So now let's try to understand the impact of this. In the first year, if you'll see, books have shown a depreciation of 100. In the books, we have charged depreciation of rupees 100. In the books, we have charged depreciation of rupees 100. But income tax did not accept this depreciation. Income tax said that I will consider a depreciation charge of rupees 200. So as a result of this, what will happen? My profit will go down by rupees 100. My income will go down by rupees 100. And therefore, I will end up paying tax which is lower than the one which I would have paid if I had considered the income as per books. Yes or no? If I had considered income as per books only, without considering the depreciation charge as per income tax, then I would have paid higher tax. But now, because I have considered higher depreciation amount, why? Because the income tax required me to do that. So that's why I will pay lower tax. Correct? I will pay lower tax on this much amount. Correct? Let's suppose tax rate is 30. Okay. Yeah. If you look at year number 2, 3, 4, 5, you can see the same thing is happening. Every year, I would have paid a higher tax if the income tax depreciation was not different from depreciation as per books. But because income tax depreciation is higher than the depreciation as per books, so that's why every year, I ended up paying lower tax. Every year I ended up paying lower tax. Can you see this? Every year same thing is happening. I am paying lower tax. Yeah? But if we go to the 6th year, things have changed all of a sudden. Why? Because when I go to the 6th year and when I compute my profit and charge a depreciation of rupees 100, income tax is not allowing me that depreciation amount. Why? Because income tax is saying your depreciation amount becomes 0. Means in the 6th year, this story gets changed. Or you can say this story gets reversed. In the 6th year, the tax that I will be paying will be higher. Why? Because in the books, I am considering a depreciation of rupees 100, but income tax is considering a depreciation of rupees 0. Correct? Yeah? Now let's try to understand why did this situation arise in the 6th year. I think we have the data available in front of us. We can clearly see that this situation in 6th year would not have arisen. To pay higher tax would not have arisen if I would have paid tax in the 1st year on the accounting profit. Correct? But because I paid lower tax in the 1st year, 2nd year, 3rd year, 4th year, 5th year, that's why I am required to pay higher taxes in the future years. That's why I am required to pay higher taxes in the future years. So we can see this higher tax liability in the future years is the consequence of lower tax amount that I have been paying in the first 5 years. Correct? Yeah. Now we are looking at one item which is depreciation. And as around this item, what do we find? That whether you charge depreciation on an asset, say at the rate 10% or at the rate 20%, asset has to become zero at some point of time. Asset has to become zero at some point of time. Yeah, means it will not matter that you charge depreciation at lower rate or higher rate. Over the period of the life of the asset, the impact is going to be same. Let's say this, in 10 years, the depreciation charge is what? 1000. And as per income tax, this depreciation charge is 1000 in 5 years. But if you look at the overall life of the asset, depreciation charge is 1000 over here and 1000 over here. It has not changed. It has remained same. What is the thing which is changing over here? What is the thing which is changing over here? Or what is the impact? It's only the timing difference. Can you see? A timing difference is getting created. What is that timing difference which is getting created? That today you are paying lower tax, and which has the consequence of higher tax liability in the future. Second year you are paying lower tax, which has the consequence of higher tax liability in the 7th year. In the 3rd year you are paying lower tax, which has the consequence of higher tax liability in the 4th year. 4th year you are paying lower tax, which has the consequence of higher tax liability in the 9th year. 5th year you are paying lower tax, which has the consequence of higher tax liability in the 10th year. So on an overall basis, if you look at this, the impact becomes zero. The impact becomes zero. Yes or no? But today, because we follow accrual concept, so let's suppose there's a problem which gets created. Yeah, let's try to understand that problem. Okay. Now I need your attention. This is important for you to understand. So these are all what? These are all timing differences which have got generated. These are all timing differences which have got generated. Yeah, all of these timing differences have got generated. Now, why are we calling these as timing differences? Because they are getting reversed in the future years. So what are timing differences? Timing differences mean differences between accounting income and taxable income. Differences between accounting income and taxable income, and which get reversed in the future years. And which get reversed in the future years. Okay. Now let's come to the problem that we are going to face. Because we are following accrual concept, so that's why there is a problem that we are going to face. Let's suppose in the first year, as per books of accounts, there is a profit of 1000. There is a profit of 1000. Okay. Now, what will happen? We will add depreciation. Which one? This depreciation we will add. And we will less depreciation. Which one? This depreciation we will reduce. So we will get a taxable profit of 900. Yeah. So this is accounting profit and this is taxable profit. Correct? On this taxable profit, we will pay a tax. Let's suppose at the rate 30% we will pay. Yeah. So 270 is the tax amount that we will pay. Now we understand this 270 is what? We understand this 270 is what? This 270 is only the current year's tax expense. What is this 270? Current year's tax expense. Where will you show this 270? You will take it to the P&L. Yeah. After PBT, you will show this as tax and then you will compute your PAT. After PBT, you will show this tax expense and then you will compute your PAT. So this will become your current year's tax amount. Yeah, this is how you compute your current year's tax amount. Alright? Yeah. Now let's understand the problem that we have. We are at one place saying that we are following accrual basis of accounting. Yeah, that is what we say. Are all of you with me? Yes, quickly please confirm. Are all of you with me? Because I have not heard from you. So that's why it's very, very important to take your confirmation. Are all of you with me? Quickly, quickly please. We need to get done with this topic. Quickly. Are all of you with me? Yeah? You are able to understand only this much part so far that we have covered. Quickly, please. Please confirm. Okay, Darshan, Siddharth, Harsh, they are saying yes, sir. Very good. And I am hoping that some of the yes are on the way. They are reaching me. Okay, great. So a lot of yes I can see. Pooja, Riya, Sandeep, Mevan, Hinacha. Great. Now let's understand the problem. Problem because of the accrual basis of accounting. We understand that due to this transaction, a tax liability will arise in the 6th year. Can you see this? Tax liability will arise in the 6th year. If we consider 30%, what will this amount become? 30. So today in the first year we are paying lower tax. Why? Because on 1000 if we would have computed, then the tax would have become 300. On 1000 if we would have computed tax, it would have become 300. But because we are required to compute tax as per the taxable profits, so that's why what is the consequence? We ended up paying lower tax. We ended up paying lower tax. What is this lower tax that we are not paying? 30. But we understand that this 30 is not something which is gone forever. No, it is not gone forever. It is only a timing difference. We understand that this is waiting to come in the future years. Why? Because of current year's adjustment that we have made. We have made some adjustments in the current year, because of which this tax liability has got shifted to the future year. So actually government is not foregoing this tax. No, government is saying we will take this tax from you, but not in the current year. Government is saying we will take this tax from you in the 6th year. Yeah. So what should we do? We should accrue this tax provision in the current year also. This future tax which is going to arise, or you can say this future tax liability which is going to arise. Why? Because of this adjustment of the current year. This future tax liability is not arising because of future year's transaction. No, this transaction is already there. This adjustment has also been made in the current year. The only thing is cash flow has got shifted. Cash flow had got postponed in a way to 6th year. So should we really go by the cash flow? Do we follow cash basis of accounting? No, we follow accrual basis of accounting. So that's why, what does the standard say? This standard says follow accrual basis of accounting and create a provision for this ₹30. This tax liability which you have saved in the current year and which is actually not a saving, which is shifted to next year, let's create a provision for the same. And how do you create a provision for the same? By calling this as a deferred tax expense. So this is also an expense. This is also an expense, but you call this expense by a different terminology, deferred tax expense. Why? Because income tax will not accept this. Income tax will say, I don't accept this. I will take only ₹270 as the tax. But in the books, we know that today income tax is not accepting, but tomorrow it will ask for the same tax. So that's why for our accounting purposes only, we are creating this tax in the books of accounts by a terminology which is called as deferred tax expense. Means deferred, a tax which has got deferred. So we are recording this as deferred tax expense. Or you can say we are recording a liability. Why are we saying it's a liability? Because it's going to be paid in the future years. Or you can say deferred tax expense which will result in a liability. Deferred tax liability. So what will be the accounting entry for this? What will be the accounting entry for this? So in the first year, the accounting entry that we will pass will be deferred tax expense debit 30 to deferred tax liability 30. Yeah, wherein this part will go to the P&L and this part will go to the balance sheet. Wherein this part will go to the balance sheet and this part will go to the P&L. Mahima and Samyak have got queries. Quickly, if you can let me know your queries. So this is about the meaning of deferred tax. This is what we consider as deferred tax. Quickly, any questions, any doubts that you may have on this, please let me know. Priya is asking, sir, please tell how we will compute tax in the 6th year. In the 6th year, once again, we will compute the tax the way it is required to be done. And what will happen in the 6th year? This deferred tax liability will become actual tax liability in the 6th year. This will not remain deferred. This will become actual tax liability. So what will happen in the 6th year? This will get reversed. This will get reversed in the 6th year. And when this will get reversed, against this actual tax liability will rise, which you have to pay. Okay. Against this, actual tax liability will arise, which you will have to pay. Okay. Please park your queries related to other topics for the time being. Please concentrate on this. Please concentrate on this. This is very, very important, and this may become slightly tricky for you. Yeah, so that's why I need your attention. If you have got any questions, any doubts, please let me know. Yes, quickly. Vrinda is saying I'm clear. Pooja is clear on this now. Okay, great. Any questions, any doubts that you may have on this, please let me know, because this is the most important part. And on this one, we will also pick up some examples, but in the next session. Yeah. So as regards some of your queries which are related to other topics, that also please park to the next session. I don't think we will be able to take it up now because we are just running out of time. So quickly, any questions, any doubts that you have on this, please let me know. And please make sure your homework, revision of AS22 concepts discussed today. Yeah. So all these concepts of AS22 that we have discussed today, please make sure you revise them. Please make sure. Otherwise, in the next session, it will become very, very difficult for you to understand. So please make sure you revise that thoroughly. Okay. Gunjan is clear on this. Fiza is clear on this. Chaitanya is asking, sir, how that 300 comes? Which 300? This one. So 270 is the tax liability on 900 and 30 is the tax liability on in the 6th year. Yeah. This 300 is on the accounting profit. So on the accounting profit, if you apply the tax rate, which has been assumed as 30%, then it becomes 300. Chaitanya is saying, sir, why did you compute 300? That was only to show you, to explain you the concept. No, Pooja, this will not pay. Pooja is saying 6th year entry will be deferred tax liability to bank. See, you can also say this will be deferred tax liability to bank, but actually it's going to be the reversal of this deferred tax liability and against which the current tax will also arise. So effectively, the accounting entry which you are giving is absolutely right. Yeah, because the expense is already created in the 1st year. So in the 6th year, only the liability will be squared off by paying it in cash. Darshan, all of these discussions, all of these points which I have been explaining you, these are of your notes only. Yeah? Okay, Khushi is clear on this, Nitya is clear on this, Pooja is saying yes, will revise. Great. Chanu is also clear on this. Great. So with this, we can end our discussion for today. Thanks to all of you once again for your time and for your wonderful participation. But please make sure that next time when we meet, you have revised all of these concepts related to AS22. Yeah, very, very important. And this topic is very important. Not only theoretically, not only for examination purposes, but practically also you will see significant usage of this concept. Yeah, so that's why very, very important. Huh? Please make sure you revise. So thanks to all of you, and I've parked your queries related to other topics, which we'll definitely discuss in the next session. So Shank is asking what will the tax liability at the 6th year? So in the 6th year, you will do this complete computation. Huh? Let's not jump onto the 6th year now. Let's stick to the 1st year only. Let's understand its impact and we'll pick up questions. You'll understand all of these points. Okay. Yeah. Clear? So thanks. Thanks so much once again.